Good evening. Thank you for joining Corporate Connect. I'm Eileen and I'm your host for today. This evening, we welcome United Hampshire US REIT, as well as our audience from Facebook Live. This webinar is organized by SIAS and supported by SGX Group. We will kick off today's webinar with a presentation by Mr. Jeff Howie, market strategist from the SGX Group on recent market highlights, followed by the corporate presentation by Mr. Gerard Yuan, Chief Executive Officer, United Hampshire US REIT, as well as Mr. Derek Vidala, Chief Investment Officer, and we will end off with a Q&A session. Listed on the main board on the Singapore Exchange on 12th of March 2020, UH REIT is a Singapore real estate investment trust established with a principal investment strategy of investing in a diversified portfolio of stabilized income-producing groceries anchored and necessity-based retail properties and modern climate-controlled self-storage facilities located in the US. The tenants targeted by UH REIT are tenants resilient to the impact of e-commerce, including but not limited to restaurants, home improvement stores, fitness centers, warehouse clubs, and other users with strong omni-channel platforms. UH REIT's portfolio comprises 21 predominantly freehold groceries and necessity properties and 2 self-storage properties, primarily concentrated in the East Coast of the US, with a property value of approximately US $738.87 million and an aggregate net lettable area of approximately 3.8 million square feet. Without further ado, I now invite Jeff to give us an overview on how the market performs. Over to you, Jeff.
Thanks very much, Eileen. I'm now sharing a screen just to run through for the next 10 minutes or so before United Hampshire REIT have their speaking session. Just to update that we, I guess, continue to book healthy investor activity in our REIT sector. The REIT sector, as we know, it represents around 12% of the total market value of all stocks listed on Singapore Exchange, yet make up so far this year around 19% of the day-to-day turnover, which is comparatively high. The FTSE EPRA REIT Developed Index, it is recognised as a global benchmark for this sector. It's designed to track the performance of listed real estate companies and REITs all across the globe, and it's comprised of 370, that's 370 constituents, of which 300 represent the global REIT sector, and placement in this index is highly coveted by global REITs due to the span of passive institutional investment flows that do track this index. From the end of 2019 through to the end of last week, this FTSE EPRA REIT Developed Index has declined around 23% in price, with reinvested dividend distributions reducing the total return to around 12% in Singapore dollar terms. The 12-month trailing yield for the FTSE EPRA REIT Developed Index stood at 4.2% as of the end of July. Now, at the very same time, this SIAS S-REIT index, which is comprised of 35 constituents that are listed here in Singapore, it maintains a higher yield of 6%. And from the end of 2019 through to the end of last week, this index declined 25% in price, so quite similar to the FTSE EPRA REIT Developed benchmark, but that higher yield saw the index decline in total return of around 8%. So the total returns of the local and the global REIT benchmarks, they have been comparable since the end of 2019 with some directional correlation. However, with the US economy's, I guess, earlier emergence from COVID, the SIAS S-REIT index did underperform the FTSE EPRA REIT Developed Index by something like 24 percentage points in 2021, while also posting 13 percentage points less declines last year in 2022. And this year, there's been pretty much more similarity in the returns between the two benchmarks, the SIAS S-REIT and the FTSE EPRA REIT Developed. So performances, they have been mixed across the constituents, and that's pretty much down to a couple of key layers of diversity that these REITs carry. In Singapore, we have as many as 17 of the trusts exclusively investing in properties outside of Singapore. 20 of the trusts invest in properties both in Singapore and outside of Singapore. And then, of course, we have the remaining 3 REITs investing purely in Singapore. It includes as many as 14 trusts with properties in Australia, 9 trusts with properties in the US, of which United Hampshire REIT is one. We have 11 trusts with properties in China. And I think also a similar number of, in Japan with 11 trusts with properties in Japan. So across the S-REIT sector, around 80% of the trusts here own and manage overseas assets from across Asia Pacific, the United States and Europe. And S-REITs are now one of the most international REIT markets. Nonetheless, the Singapore AUM of the S-REIT sector is quite large, and recovery momentum has been a key driver for interest in the sector this year. In the second quarter of this year, Singapore's real estate sector grew by 12% year on year, following the 7% year on year expansion in the first quarter of this year. And that's supported by private residential property segment, as well as the commercial office and the industrial space segments. Singapore tourism activity is also poised to recover by next year for local property assets. So that, I guess, is an important point, because the S-REIT sector is overall very well diversified in the type of properties in portfolio. So diversified S-REITs now make up the largest sub-segment of the REIT sector. I think there's 9 diversified trusts in the S-REIT sector, and that makes up about 4% of the S-REIT day-to-day turnover. Geographical mix and multi-asset portfolio management basically allow managers to diversify risks across industries, customers, and currencies as well. So the 40 REITs, they ended July with an average gearing ratio of 37.9%. That's below the regulatory limit of 50% if the minimum interest coverage ratio is at least 2.5 times. And the average yield for the 40 S REITs was 7.8% at the end of July. Now, much of the 20 plus years of the success of the S REIT sectors has been attributed to their comparatively high yields and the institutional and retail investor appetite for the dividends that come with those yields. Since the end of 2021, in total, the S REIT sector has booked around 2 billion Singapore dollars of net retail inflow. SGX also now lists 5 real estate investment trust focused exchange traded funds for trading, and the 5 ETFs all saw trading turnover advance by about 20% in July from June. The S-REIT focused CSOP IAG S-REIT Leaders Index ETF, it led the increase in retail and institutional trading. It accounted for more than a third of the combined turnover of the 5 REIT focused ETFs in July. And that followed on from the combined assets under management of the 5 REIT-focused ETFs, which came to about 875 million Sing dollars at the end of June. And that was also on the back of 108 million of combined net inflows over the first 6 months of the year. So the CSOP IAG S-REIT Leaders Index ETF, the Lined Phillip S-REIT ETF, the Nikko AM Straits Trading Asia X Japan REIT ETF, they all maintain also higher dividend yields than 5% as of the end of last month. On the interest rate front, interest rates may peak at some point, despite some mid-year uptick in advanced economy inflation gauges. Global inflation is trending lower, and majority expectations that the US Fed funds rate is now at peak are in place. And majority expectations think the Fed will start cutting in the second quarter of next year. However, as we've seen over the past week or so, the expectations that the Fed funds rate could be 25 basis point higher by the time of the third FOMC before the end of next year, before the end of this year, which is on the 13th of December. So in 3 FOMC times, the expectations that the rate could actually be a higher 25 bips rate, those expectations have increased from around 25% to 40%. And the Fed minutes, they noted upside risks to inflation they included two key scenarios: that supply chain improvements and favorable commodity price trends did not continue, and secondly, aggregate demand fails to slow by an amount that's sufficient to restore price stability over time. So that could lead to more persistent elevated inflation or an unanchoring of expectations. That was the key lines in last week's Fed minutes that have seen yields creep up a little bit. But on the aggregate demand front, the second quarter US earnings were overall better than expected or less than feared. Refinitiv maintained that more than 90% of those US stocks for the second quarter have now reported, and you had double the amount of stocks that beat earnings versus those that missed. And finally, just on the interest rates and how that's creating some pretty fluid trading conditions as well. Fed speak also matters. And of course, 4 incoming FOMC voters next year: Tom Barkin, Raphael Bostic, Mary Daly, and Loretta Mester. They all acknowledged last month that US inflation was too high. So just kind of pointing out that still a little bit of volatility on the outlook for rates in the market. And of course, I mentioned before, we have our IHS REIT Leaders Index, or our IH index as well. And we also have futures contracts on these indices, as well as on the FTSE EPRA REIT Asia ex-Japan REIT Index, which enables investors to take leveraged long or short positions. And those short positions can obviously serve portfolio managers looking to hedge their S-REIT exposure as well in anticipation of volatility or price decline. So the size of the futures contracts, assuming a futures price of 1120, let's say August IHS REIT Leaders Index futures maintains a notional value of around 28,000 Singapore dollars. You don't need $28,000 to fund that position. It runs on an initial margin requirement, which is in the vicinity of 1,210 Singapore dollars per contract. And each minimum 0.3 move in the index is worth $7.50 Singapore dollars per contract. So just pointing out that in these times of volatility for the portfolio managers, there are products available to help mitigate against some market risk if portfolio managers are attempting to do that. But overall, I should conclude just to point out that the S-REIT sector, as benchmarked by the IHS REIT index that we've discussed, it has grown at a compound annual growth rate of 7% over the past 10 years. The FTSE ST REIT index, it does maintain a 10-year total return of very close to 70%. Part of that journey has been the listing of Asia's first US grocery anchored shopping center and self-storage REIT. That was, as Eileen mentioned, back in March 2020. And that REIT is serving obviously the non-discretionary needs of the US consumer. So I think without further ado, it'd be a great time to invite United Hampshire REIT, and very much looking forward to hearing from Derek as well as Gerard tonight. Thank you.
Thank you, Jeff. Good evening, everyone. Thank you for joining us for this presentation. So United Hampshire US REIT, it's so named because our sponsors and major shareholders are United Overseas Bank, or UOB, and the Hampshire companies. UOB, I'm sure all of you are familiar with. Hampshire is a US-based integrated real estate firm. They have over 60 years experience, and they own and operate a $2 billion portfolio of 150 properties across the United States. For UH REIT ourselves, we own grocery anchored shopping centers. These are single-story shopping centers located in the US suburbs. They typically have a supermarket as the anchor tenant, small shops located next to them. For instance, we have DIY shops, health and beauty shops, casual restaurants. Our other asset class is modern climate-controlled self-storage properties. We are listed on the SGX main board since 2020, just before COVID. Our total AUM is over $1 billion Singapore dollars, or US $740 million. Next slide. We own 23 properties in total. They are all located along the US East Coast, which is very densely populated and has high income levels. Since IPO, we have acquired 3 new grocery-anchored properties and sold 2 self-storage. Slide. Next slide. Moving on to our first half results, I think it's helpful to first recap how the US economy has performed this year. Whilst many of us have read about the challenges of the US office property market, overall the US economy has been doing well, as Jeff summarized earlier. US GDP grew 2.4% this quarter, far exceeding expectations. US consumer confidence hit a 2-year high in July. The US consumer continues to spend strongly, with retail sales up 3.2%. Unemployment in the US remains very low at 3.5%, and thankfully inflation has begun slowing significantly. It's now around 3%. And although the Fed raised interest rates by 25 basis points in July, I think as Jeff shared, there seems to be a broader consensus or optimism that we may be near the end of the rate hike cycle. Even in his recent interview, Fed Chairman Jerome Powell has shared that the Fed is now no longer forecasting the US recession. In terms of UH-REIT's properties, these provide essential day-to-day goods and services. The US consumer makes up 2/3 of the economy, and they continue to spend strongly. Like all of us, they still need to eat, buy their day-to-day groceries and necessities. Our properties have also benefited from the work from home trend, as they are located in the suburbs where people live. So they frequent our properties to buy their food and other day-to-day items. Or they may make use of our self-storage facilities when they move home out of the cities, or just to declutter, create a more comfortable home office space. Occupancy at our properties continue to reach new highs. Occupancy is now 97.9% for grocery properties, the highest since IPO. We have an extremely high tenant retention rate of 92% and have completed almost all of our leasing for this year, with less than 1% expiring this year. We have one of the longest WALE amongst S-REITs of 7.2 years. On the capital management front, we proactively refinanced our maturing loans at the end of last year and have no refinancing requirements this year, and only a small $21 million mortgage loan due for refinancing next year. 81% of our loans have been hedged into fixed rates. We have also been proactively managing our portfolio to enhance the REIT's income. We recently entered into an agreement to sell Big Pine Center, the Florida Keys, at approximately 8% premium to our purchase price. Next slide. Sale price of Big Pine Center is $9.9 million. This is a 3.7% premium to the latest valuation as at 31st December 2022, and 7.7% premium to our purchase price. This sale is part of our overall portfolio management and rejuvenation strategy, where we regularly review our portfolio to identify opportunities to improve the quality and yield of the portfolio. Using the proceeds to pay down debt will reduce our gearing by almost 1% and provide us greater flexibility going forward, financial flexibility. Transaction is also accretive to our distributable income, as our interest savings will outweigh the contribution from. As we've shared in some of our previous presentations, we proactively look to grow the REIT's DPU organically through development and asset enhancement initiatives. I'm pleased to share that our new development for Academy Sports is progressing well. This is a new 63,000 square feet building that we are constructing on excess land in our Port St. Lucie property in Florida. The tenant is Academy Sports and Outdoors. They are a Fortune 500 company and one of the largest sports goods retailers in America. We have a new 15-year lease with them. Construction on the store started earlier this year and is progressing very well. We are targeting to complete the store in 2024 and possibly even earlier sometime this year if all goes well. Once completed, This large new store will provide significant additional revenue to the REIT and also increase the footfall and overall attractiveness of the property. We'll continue to look out for other similar asset enhancement opportunities within the portfolio. Next slide. In terms of our financial performance for the first half of this year, as you can see, this has continued to be strong. We see strong growth across revenue, net property income, and distributable income. Overall, first half 2023 revenue was 13.3% higher than the previous year, whilst NPI was 14% higher. Distributable income was 2.2% higher than last year. This is highly commendable achievement, given that interest costs have been rising and has been impacting the distributable income of many of our S-REIT peers. Our strong performance is due to the new leases we have signed, rental escalations from our existing leases, and contribution from Upland Square, which is the latest property we acquired in July last year. In terms of DPU, our first half 23 DPU is 2.65 US cents. Due to capital projects such as Academy Sports, we have elected to retain US 1.5 million as capital reserves for CapEx. Without this, our DPU would be 2.91 cents, which is actually the same level as the DPU last year. That was a very strong performance. Even with this retention, our trailing 12-month DPU yield is still a very attractive 12.8%. I think Jeff mentioned the average yield of the other S-REITs is 7.8%, so it's significantly higher than that. Here are the key dates for the upcoming distribution. We continue to offer the DRP or Dividend Reinvestment Program for this distribution. In other words, existing unit holders, you have the opportunity to take some or all of your dividends in the form of units or cash. This is purely optional, but it gives you the opportunity to increase your stake without incurring brokerage or other transaction costs. Reminder, do submit your notice of election by 12th of September. Dividend payment will be on 28th of September. Turning to our balance sheet, as you can see, it remains healthy, and our NAV is largely unchanged at US 74 cents. In terms of capital management, I mentioned earlier that we proactively refinanced all our loans at the end of last year. We have no refinancing requirements in 2023 and only a small 21 million mortgage loan due next year. We have a long weighted average debt maturity of 3.5 years, and 81% of our loans are hedged to fixed rate. With that, I'd like to hand over to Derek, who is our Chief Investment Officer of the REIT, to share with you the detailed portfolio update.
Thank you, Gerard, and good evening, everyone. We're very pleased with our portfolio performance to date, as demand for space remains strong and occupancy reached a record high during the first half of 2023. Occupancy, as on a year-over-year basis, has also been very stable. Leasing activity for the first half of 2023 consisted of 3 new leases and 19 renewal leases, comprising over 331,000 square feet. Overall, since our IPO, we have achieved a high tenant retention rate of 92%. On the next slide, we've been very fortunate to attract high-quality tenants to our properties who have commenced occupancy over the past year, which include Bell's Outlet at our St. Lucie property, Ashley Furniture at our Town Crossing property in New Jersey, and Raising Cane's at Penrose Plaza in Philadelphia. Raising Cane's is actually a fast food concept that has been expanding rapidly through the US and offers different types of chicken sandwich offerings to the US consumer. We're very excited these brands have chosen our properties because of the high density in the markets in which they exist, as well as the strength of the anchors at all of these properties as well, the anchor tenants at all of these properties. On the next slide, we wanted to provide you with an update on our self-storage portfolio. Despite normalizing fundamentals across the self-storage sector, our assets continue to demonstrate strong occupancies and increasing rents on a year-over-year basis. This is driven by limited supply of self-storage facilities in these markets, as well as the close proximity to New York City, which is within a 1-hour drive. Also, in comparing the locations of these properties to the broader national trends, these properties are situated in the New York metro area. And ultimately, there is an undersupply of self-storage facilities in the New York metro area, as you can see in the chart at the bottom of the page. So we have, while we may see some volatility in occupancy over time, these properties are stabilized, we have strong rents, and we're very pleased with the performance of these assets. Now we're going to, on the next slide, take more of a focus on the retail portfolio in detail. And first, we'd like to share with you our top 10 tenants. Our top 10 tenants comprise cycle-agnostic sectors, including discounters, grocery stores, wholesale clubs, home improvement stores. Our top 10 tenants deliver a WALE of 8.7 years, and 90% of our top 10 tenants provide essential uses to the U.S. consumer. As you can see, on the right-hand side of the page, we have a trade sector breakdown, which shows 63% of our entire portfolio provide essential uses to the U.S. consumer. And these essential tenants provide a WALE of over 8 years. On the next slide, we'd like to just highlight the success of our tenants in the marketplace today. And as an example, Ahold Delhaize, which operates the Giant as well as Stop & Shop brands within our portfolio, reported earnings within the last 2 weeks, and sales are up 3.6% over the prior quarter, with increasing brand loyalty and online consumer penetration. Walmart also reported sales last week with a 6.4% increase, as well as further market share penetration and adoption in online orders, with the store being utilized to fulfill those orders. Many online orders that you see today from the U.S. consumer are fulfilled within the local store that's in closest proximity to the consumer, enabling them to pick up their goods or have them delivered. On the next slide, we wanted to just provide you with an overview of our ESG initiatives at UH REIT. ESG plays an important role in regards to the operations of our portfolio and properties. On the environmental front, we aim to install electric vehicle charging stations, as well as LED lighting and solar panels at various properties within the portfolio. We also remain focused on maintaining a high standard of corporate governance and transparency, engaging with our communities, and also fostering a workplace that promotes a high level of employee engagement. And now we're going to move to the outlook section. And as we think about the U.S. economy today, macroeconomic indicators continue to tell a varying story, and we are seeing outperformance ahead of expectations on a number of levels. That would include within GDP, as well as employment gains across certain sectors, such as healthcare, financial, as well as construction. The challenge for us is, the inflation rate. And ultimately, while the inflation rate has gone down significantly, the question still remains as to when the Fed will stop its period of interest rate increases. On the next slide, we want to provide just a highlight of retail sales. And consumer confidence reached a 2-year high in July of 2023. The consumer is also shifting its spending patterns to lower priced products and necessity goods and services, which includes those products and services being offered at our properties. The majority of our tenants at our properties offer essential goods and services to the U.S. consumer. And as you can see, with the numbers that were released within the last week on U.S. retail sales, grocery sales as well as retail sales more broadly, continue to perform well. On the next slide, we wanted to provide a highlight, an overview for everyone of omni-channel retailing. And omni-channel retailing is really the key to a retailer's success because it offers the consumer multiple ways to order and pick up their goods. Whether the consumer chooses to buy their goods in store, buys their goods or picks up their goods in curbside, which would be in front of the store, where they ordered the goods online previously, or they could buy online and pick up in store. Ultimately, there are various different apps for the consumer to use offered by each retailer to enable the convenience of ordering and picking up goods however the consumer would like to do so. Additionally, one important portion of the physical store is also used for consumer returns and exchange of goods. So this enables the consumer to utilize the physical store really as a last mile distribution center for picking up their goods as well as returning them. Also, we'd like to introduce the concept of mobile commerce and phygital retail. Mobile commerce is the idea of a consumer using their mobile device to order goods. And phygital retail is this concept that combines the best of the digital device as well as in-store shopping to best serve the consumer. And the idea would be, as an example, walking around a physical store and clipping coupons on an app. And when you get to the checkout line, putting in your customer loyalty number and having all of your coupons automatically load into the system. And so all these different digital technologies provide the opportunity for convenience within the framework of the physical store. Retailers are also continuing to expand. Aldi is a great example of this with its 120 stores that are being added in 2023. Also, Aldi recently, over the past week, announced the acquisition of a large supermarket company called Winn-Dixie, and that's going to add hundreds of stores to Aldi's portfolio of retail stores. On the next slide, we wanted to highlight new innovations and partnerships for enhanced distribution. As we've mentioned, the physical store that is offered to the U.S. consumer at our properties the physical stores are based in open-air, single-story shopping centers with large car parks and provide ample opportunities for the distribution of goods out of the physical store. Work-from-home trends are also enabling the consumer to rely more on the shopping center to serve the everyday needs of the U.S. consumer. This is due to the fact that the consumer being at home and working from home may make multiple trips to the shopping center, one to the grocery store, another perhaps to any of the other stores at the shopping center, which may include restaurants, coffee chains, hair salons, and even medical facilities. And expanding in technology innovations have also been utilized to enhance the consumer experience. And by example of this, Staples, which is a U.S. products office supply store, is accepting returned merchandise by consumers to be shipped back to Amazon. And Target introduced something similar earlier this year. Also, there are different partnerships that have been formed to distribute goods to the consumer out of the physical store, where those retailers don't have direct delivery capabilities out of the store. And companies such as DoorDash has created a number of partnerships with retailers, as you can see on this page, that ultimately enable the consumer to do their shopping in store, to do their shopping online, if they don't choose to in store, and then have the goods delivered from the store to the consumer. On the next slide, we wanted to highlight ultimately the resiliency in self-storage and strip center property values. And this is based on the Green Street Commercial Property Index. Ultimately, as you can see, the property values for self-storage and grocery anchored shopping centers, called strip centers on the page here, remain strong, and they've been quite resilient over the last 3 years. This is driven by the favorable demand-supply factors of the space that has been available in the suburbs. Our properties are situated in suburban locations outside of cities, and so they are in close proximity to where people are living. And in addition to that, our shopping centers provide easy access to the U.S. consumer to make multiple trips during the course of a week. As I mentioned, we've benefited from the work from home arrangement, because this gives the consumer the opportunity to make multiple trips to the shopping center for a variety of different purposes. And we also want to make sure the investors understand that our property types behave very differently than the other property sectors, as you can see on this page. And on the next slide, we thought it'd be helpful to provide an overview of the retail and self-storage sectors. And ultimately, grocery-anchored retail, grocery necessity retail continues to demonstrate resiliency. Demand for space is at a record, and that's evident by the strong occupancy we have within our portfolio. Retailer store opening plans have not been deterred by the varying macroeconomic story across the macroeconomic environment. And several retailers, in addition to Aldi, as I mentioned earlier, which is a supermarket chain, have been looking to open stores, which include discounters such as TJX Companies that operates the TJ Maxx, Home Goods, and a couple of other brands, Burlington stores, as well as Ross. And so retailers are really looking to open new stores. And a lot of the demand that we see in the marketplace today is due to the limited supply. There has been very limited retail development across the country as a result of elevated construction costs and high interest rates. And so this limited development is creating demand for retailers to expand at existing shopping centers. And when retailers are looking to expand and there's only a finite amount of existing shopping centers, obviously there ends up being a strong demand for space, which we've been seeing across our portfolio. As it relates to tenant sales, health and beauty segments, as well as food and beverage, have stood out quite strong this year, while other sectors such as home furniture, electronics, and apparel, have seen some declines. There's been limited transaction activity within the market as well. There still remains more interest in smaller deals versus larger deals across the marketplace. And then there was one REIT, a US-based REIT, that was acquired by a larger competitor called Regency earlier this year. And that transaction was approximately $1.2 billion. On the next slide, we wanted to just provide a quick update on the self-storage sector. Our assets continue to perform well, and the sector continues to normalize. Fundamentals for self-storage reached a peak in 2021. And ultimately, while move-in rents may not be growing as much, it is anticipated that customer rent increases are going to be basically driving the revenue, existing customer rent increases, that is, are going to be driving the revenue growth in 2023. Also, while self-storage has had a more robust development pipeline across the country, that has become more difficult because of limited capital available from banks, as well as increased construction costs. Transaction activity for self-storage has also been limited, given the market challenges that are faced nationally, but our assets continue to remain strong. And with that, thank you for listening, and I'll now turn it over to my colleague Joey, who's going to share a short video with you on one of our properties.
Welcome to Colonial Square, the premier grocery-anchored shopping center in Colonial Heights, Virginia. Boasting an impressive occupancy rate of 97.6%, Colonial Square is the hub of commercial activity in the area, offering top-of-the-line amenities and an unparalleled shopping experience. Located at the intersection of Boulevard and East Ellerslie Avenue, Colonial Square enjoys superior access from surrounding neighborhoods and major commuting corridors, such as Boulevard, I-85, and I-95. Its prime location makes it the go-to destination for discerning shoppers seeking convenience and quality. Spanning over 168,000 square feet with 619 parking spaces, Colonial Square is home to 18 tenants, including anchor tenants Publix, the largest employee-owned supermarket chain in the U.S., and Lock Supply Co., a plumbing, electrical, and HVAC distributor with over 180 stores. With limited grocery store options in the area, Publix provides the community with premier quality food and a large inventory of necessity-based products. Colonial Square is at the forefront of responding to the needs of today's customers. According to Forrester Research, digitally influenced retail sales where consumers research products online but buy or pick up in stores will represent 62% of total sales in 2023 and 70% by 2027. Focused on providing a seamless customer experience, tenants across property offer a wide range of buy online, pick up in-store omnichannel shopping options and continue to refine their shopping experiences around the needs of today's consumers. Colonial Square is also dedicated to environmental sustainability, with the installation of LED lighting to reduce energy consumption, lower its carbon footprint, and cater to eco-conscious shoppers. With its strong and diverse tenant base, a superior location, ample omni-channel shopping options, Colonial Square continues to fulfill the evolving needs of today's consumers and is a valuable piece of the United Hampshire's US REIT's grocery and necessity-based real estate portfolio.
Thank you, Derek and Gerard, for the informative presentation as well as the video that says it all. We now come to the last segment of today's webinar, which is the Q&A. I now invite the CEO, Mr. Gerard Yuan, as well as Mr. Sivanity. He's also our senior consultant as well as our investor education and editorial to moderate tonight's session. Over to you guys.
Thanks very much, Eileen. Thanks, Derek and Gerard, for the presentations. I think I'll start with questions that were pre-submitted before going on to those that have been submitted recently online. Okay, the REIT has retained about $1.5 million in distributable income for various reasons. So one of the questions is this going to be the norm going forward?
Sure.
Okay, the question said it was 10% retention, but I'm not sure whether the 1.5 million was 10% of distributable income. But anyway, the question is this going to be a normal feature from now on? And if so, for how long?
Yeah, sure. Thanks very much for that question. Yeah, the 1.5 million, it's about 9% retention. I think as we mentioned, and I think it's worth re-highlighting, we have the project Academy Sports, which is being under construction now. That's a $12 million project, but it will significantly contribute to DI once it's up and running.
Right.
In terms of how to fund it, I think we decided to be quite prudent about it. Interest costs are quite high now, and we didn't want to keep borrowing more, increasing gearing. So we felt that retaining a small proportion of the income would be a prudent way to finance it. As for going forward, it's a bit hard to say right now. Obviously, we'll look at operational needs at that point in time. I would like to highlight as well that we also announced the sale of Big Pine Key as well, Big Pine Center. That happened subsequent to the retention, and that's another 10 million or 9.9 million of divestment proceeds that we'll have. So I don't have an answer for you. I think the amount that we retain, if any, for each subsequent period will be decided at that point of time, depending on the operational requirements of the REIT.
Right. Thanks for that. Speaking of the sale of Big Pine Center, there was also a question asking for management to share the rationale, but I think you already shared that in your presentation by saying that the money was used to partly bring down debt, right? And okay, so on that point, quite a few questions relate to bringing down the gearing. So I think you said that the sale enabled you to bring down your gearing ratio by about 1%. Am I right?
Yes, that's correct.
So does it bring it down to about 40 something now? 40, 41?
That's right, 41.
Okay. So we've got 3 questions that were pre-submitted, all relating to the same point. How will United Hampshire bring down the gearing? Is there any plan to reduce the gearing ratio? And yes, essentially the questions relate to that going forward.
Well, thanks. Fair question. I guess just a quick bit of background as well. I think some REITs have the gearing has gone up because valuations came down. I think in our case, it's quite different. If you look at our valuation as of December last year, it actually went up 1.3%. Valuations went up. And I think you can see from the price that we sold Big Pine Key, at a 3.7% premium to that valuation, market values can be quite resilient in our sector because of the performance. Now, the reason why we went slightly above 40% in our gearing was actually because of the acquisition of Upland Square in July last year. Now, when we bought that property, there was a $40 million mortgage loan, which was a 4-year fixed rate loan, but it was a very attractive rate of 3.62% all in. So it was actually a very attractive mortgage loan that we could assume. So we took the decision to assume the mortgage loan. And that resulted in our gearing going up from 38% to 42% is where we currently are at. I think, so it's not caused by valuations coming down. I think generally speaking, I would say we're very comfortable with our gearing where we are. Our interest coverage ratio is strong. The occupancy of the properties is at an all-time high. Rentals are strong as well. Having said that, I think generally speaking, you can tell from the tone of questions that I think unit holders prefer to have gearing somewhere in the 30s, right? So I think we certainly take that on board. We sold one asset, Big Pine Key, that brings gearing down. We will certainly take that on board and look at the portfolio as well.
Okay, thank you again for that, Gerard. Quite a few questions here on the fact that your fundamentals are good, performance has been good, but the REIT's price seems to be underperforming. One question is that it's significantly below NAV. I think your NAV you showed earlier was about 70 odd US cents. Was it 78 cents? I think 74. Okay. So today in the market it closed at 39 cents. So the question is, are there any plans to increase the marketing of the REIT to raise awareness? This gentleman named Darren Toh has asked this question. We could say that it is bad market sentiment and generally the entire REIT sector took a beating, but could it be that the marketing side marketing to institutional investors need to know more about what this REIT is doing? Would you be able to share some marketing efforts to shore up and to perhaps publicize the benefits and the merits of the REIT? I think that's what the question is.
Thanks, Darren and Siva. Very good question. I think one of the things is, we agree with you. I think operational and financial performance of the REIT has been very strong, as we all see. Obviously, unit price is the one thing that's out of our control, right? So we can do the best job we can on the operations and the financial side, but unit price ultimately is dictated by the market. It's not something we can control. I think one thing is fair to say, you can't underestimate the impact of rising interest rates because REITs are generally a dividend stock, and the aggressive way that the Fed has increased rates, since the start of last year, I think has affected all REITs across the board, but in particular the US REITs like ourselves, right? So I think there has been, a broad macro impact that has affected us to some extent, even though the operational performance is doing very well. I do think as well, our asset class, we really like our asset class, and I think it's shown the resilient performance, through the pandemic, through the Ukraine war, through all sorts of rising interest rates as well. But it's not an asset class that's well known in Singapore. We don't really have, these types of properties in Singapore. The closest we have are suburban malls, but even those are quite different because they have a lot more discretionary stores. Right. So I think Darren's point is very good. we certainly are trying to ramp up the investor relations and education. So the video you saw, which highlighted one of the properties, that's one video in our new series of videos, short videos to give people a better sense of what the properties look like. We have 4 in total. They're all on our website. Please, share that with your friends as well. I mean, we think it's a very good way for people to understand the properties and get comfortable with it. We're very active in terms of, I think the picture you see here, we participated in this year's REIT Symposium. We had a booth there that was manned throughout the symposium. A lot of interested people came and spoke to us. And we also presented at one of the big panel sessions there as well. So we're active on that front. Obviously, webinars like this one, we're quite active. Last week, we were in KL presenting to investors. Next week, we'll be in Bangkok presenting to investors as well. So yeah, I think, it's a fair point. It's certainly something we're doing. I think over time, we find that investor familiarity is growing. We're active on social media as well. We have a LinkedIn account that's pretty active. We've got more than 300 followers now. And certainly we'd appreciate if all those people on this call would be happy to follow us as well, so you get all the latest updates, when we publish it as well.
Right. Okay, I hope that's a good enough answer. There's another question here. Why is it that the REIT does not reveal its rental reversion figures in its financial report? Question from Mr. Alex Ng.
Sure. Thanks, Alex. So in our case, we're a little bit unique. Unlike most other REITs, we have really very long leases. And you've seen, right, our WALE is 7.2 years, is one of the longest. We have 97.9% occupancy. And every year we have a very minimal number of leases that are actually being renewed and signed. And so while we do have a reversion figure, because it's such a small sample size, we feel that just disclosing the number, that number can be quite volatile because you have, let's say you only have three leases, renewed this quarter or this month. That number can be skewed high or skewed low. What we do share with people is that the overall reversion of the portfolio is positive. This first half of this year, we signed 19 renewal leases. 13 of those leases had higher rental rates on day one. 3 of those leases had higher rental rates during the lease term because we have rental escalation clauses built into them. And 3 of them actually have flat rental. So not lower, but same rental as before. As you can see, of the 19 or 16 are higher and the other 3 are flat. So our overall reversion is positive. We just a bit reluctant to share a number because sometimes it may not be fully representative of the overall portfolio.
Okay, fair enough. Casey Chiang has a question here. Crystal Mall in Connecticut was recently sold at 9.5 million after being valued at 153 million a decade ago and so forth. Given the steep discounts that some malls are trading at, is United Hampshire REIT expecting a significant valuation drop in its next revaluation exercise?
I can take that. Just to provide some context first, our properties are open air grocery anchored shopping centers.
Right.
Based on US terminology, and this can be a little bit confusing, they are not malls. They are open air grocery anchored shopping centers. Crystal Mall in Connecticut is an enclosed mall. And that is, we serve the essential needs of the US consumer. Enclosed malls in the US generally offer those discretionary products predominantly, such as apparel or different department stores. So while we cannot forecast our valuations, there is a very big distinction in the US and how our properties operate in comparison to a traditional mall. So we are not malls. Our properties are not valued like malls. They don't have the tendencies of the tenant composition as well as the renewals. And our portfolio, if you look at that example of Crystal Mall, the occupancy was probably challenged. I don't remember the specifics of it. I do recall seeing it in the headlines. But as an enclosed mall, that obviously the enclosed mall sector has had tremendous stress on values simply because they're offering discretionary goods that consumers can just simply get elsewhere. Our properties, open air, grocery anchored shopping center, serve the essential needs of the US consumer. Very different investment profile. And our properties remain in demand by tenants as well as the capital markets and investors.
Right. So you're not actually comparing apples with apples, essentially.
Correct. It's apples and oranges.
Okay. All right. Okay. There's a question here from Ignatius Lim. May you offer us some insights as to why the REIT's portfolio contains a leasehold property, Wallington ShopRite, given that in the US property market, leasehold is typically not the norm? What are the merits of this specific property as opposed to divesting it to lower gearing or purchasing another asset? Is there no other options available?
So I can certainly provide some context there. First, let's look at the investment opportunity set. Or actually, let me speak to Wallington as a property itself. It is an open air grocery anchored shopping center in a highly dense area of New Jersey. The store, operated by ShopRite, does extremely well. And given the limited number of grocery anchored shopping centers in the market that were for sale previously, as you may recall, this was an initial seed asset, one of the many seed assets to the initial IPO portfolio. The opportunity that we had to invest in this property was as a leasehold position since the owner was not interested in selling the land. I would say that in the US, there are many different types of leasehold positions that owners own across all property types, actually. While it may not be as common as owning the building and the land, this was the opportunity that we had, and it's performed extraordinarily well for us. Right. We have an excellent supermarket tenant at the property, and over time, it has performed very, very well. So I would look at it as we had this opportunity to invest in a very good area, while the structure was not as optimal as we would have liked. And I believe this was an acquisition most likely in around, I would say, originally as a seed asset back in 2014, 2015, maybe. This asset has performed very well. It's done very well for the IPO. It's not the optimal ownership structure, but it is an opportunity that we had to go into a market that is incredibly dense and that is also in very strong demand. The supermarket does very well in this location.
Excellent. Thank you. Okay, we are actually a bit short on time. I'll have one or two more questions. There's one here, an interesting one from Weng Fu Lee. Has United Hampshire considered diversifying into the office sector, given the high yield and depressed valuations?
I think, I'll take the easy answer. I mean, our investment mandate is for grocery anchored and for self-storage. I think we need to go to unit holders to amend that and change that.
That's right.
And I think the simple answer at the point of time now is I don't think unit holders would be supportive of that. I think there are issues in the office sector as we see. So probably the answer should be not at this point of time.
Yes.
There are a lot of opportunities in our space to acquire assets. Obviously, we'll wait for the right timing. Interest rates are still quite high now. and there are not a lot of properties that are available at cap rates that make sense. But probably not something we actively consider as well. Why?
Okay. Right. Thank you. Okay. What is the cost of this question from Ki Wang Long? What is the cost of construction of Academy Sports, and is this considered an e-commerce resistant store? And when will it start to contribute to the income of the REIT?
I'll start, and Derek can chime in on the e-commerce bit. The construction cost is 12 million. We already own the land, so it's being built on a piece of excess land. So the building only costs 12 million to build. We are in the midst of building it right now. Progress is going very well. We want to be conservative and say we're ready early next year. But we are trying to get it done earlier, sometime this year as well. So obviously that will be a significant uplift because it is quite a sizable store, 63,000 square feet. As for e-commerce resistant, maybe Derek, based in the US.
Sure. One of the interesting things, and we talked about this during the presentation, is e-commerce and the physical store blend really well together. So somebody electing to order goods online has the optionality to pick them up in store. Obviously, Academy Sports is it'll be over 60,000 square feet. It's a large store. Academy Sports has been rapidly expanding, and we're very excited that they'll be at this location. Sporting goods is certainly an emerging is a really strong is a good category for us. And while I don't know what percentage of orders would be placed online or in store, I think the important takeaway is the physical store is the epicenter of the consumer experience, and the ability for the consumer to have that optionality to order online, pick up in store, or have those goods delivered, which in some cases may be fulfilled in store, I think is a really important factor to consider.
Right. Okay. We'll try to take another couple of questions. There's one here from Alex Ng. Strip malls attract footfalls and are focal points in the areas they serve. Why is the REIT not considering building self-storage properties at their strip malls, which have large, ample open spaces for development, high human traffic, rather than locating them at standalone locations? Would this actually be self-reinforcing for both assets?
Why don't I start and Derek can chime in as well? I think, look, it's an interesting idea. I think we did mention we're open and we'll look at all sorts of asset enhancement and development opportunities at our properties. So Academy Sports, we built a new building at an existing space. There's another new tenant that we might be looking at building next to it as well. Certainly, in terms of going beyond the asset class, like you mentioned, self-storage, I think we will certainly not rule out any of these as well. What I would say, though, is that we obviously have to look at, there are quite specific planning missions and rules and property use that has to be considered as well. And obviously, market demand of that particular location as well. So there are quite a lot of factors to bear in mind. Maybe Derek can just chime in a couple of additional points.
Sure. It's interesting. Across different markets, self-storage behaves differently. And so while a market may be great for grocery anchored retail, there are many different factors to consider for self-storage. And with the large car parks, the large car parks are there as a convenience to the consumer, and the tenants like the large car parks because that means a lot of consumers can easily park. Certainly we are always focused on evaluating organic growth initiatives and what we can do, as Gerard mentioned, at our properties to boost net operating income. And self-storage, though, does behave a little bit differently. And, when we've assessed most of the properties over time to see if self-storage could be built in their markets, and some do work, some don't work. But the size of the property itself, while it does have a large car park, may not actually be conducive given the high volume of sales each store is doing. We need to get also tenant approvals and town approvals because all shopping centers have parking ratios, parking requirements. So it's a very interesting suggestion. It is a little bit hard for us to execute, given the fact that the tenant leases, zoning requirements, and things like that. But certainly, we'll continue to look at that as an opportunity within our portfolio.
All right. So definitely something worth considering. Okay, I'll take a last question here and call it a night. Ignatius Lim has asked this question. Due to the way the legal structure is, UH REIT is not in a position to take up any non-exercised rights in the case, in the event that there is a need for a rights issue due to ownership limits. What is the management's team, or what actions have been taken to mitigate this? I'm not sure whether this is right, but yes.
Sure. Actually, this is a tricky question in the sense that I think a lot of people have been talking about rights issue because of the situation around one of the US office REITs. But frankly, I think I did want to stress, and it's very important for us to stress again, our our gearing has not gone up because of valuation decline. Valuations were up in December. And, as you've seen from the sale of Big Pine Key, we managed to sell that at a premium to the December valuation as well. Right. So the valuation and our asset class is very resilient. You can see from we've hit our all-time high occupancy. Rental reversions are positive. We have a very long WALE, and financial performance has been very strong. So I don't really want to deep dive too much into, talk about rights issue, which is really a very theoretical thing that may be applicable to some select REITs, but maybe not others. I guess what I would say is that rights issues typically are underwritten by banks, who will then place it out to investors. So it's not, we have seen cases where sponsors may be involved in a transaction, but in our case, the 9.8% limit is a US REIT requirement. So I think any participation by anyone would have to adhere to those limits. But I really don't want to spend too much time on rights issues because I think that applies to certain REITs, but not across the board.
Okay, I think we've actually overrun by quite a bit. So perhaps I can hand this back to Eileen from SIAS and thank Derek and Gerard for very, very informative answers and a very, very informative presentations. Eileen, back to you.
Thank you, Siva. Thank you, panelists. I believe we have got better clarity after the management sharing tonight. We have a bit of overrun today. In fact, I think a lot of questions are out there. You may reach out to the investor relations of the company. They will probably answer you in a direct manner. So before we end, thank you once again, Gerard and Derek, for tonight's session. Just to highlight to the audience tonight, if you missed any part of tonight's session, you can watch the webinar on SIAS YouTube channel. So Corporate Connect is our monthly webinar. You can get updates from on our upcoming investor education programs on our website. Feel free to just give us a call or email us if you have any further questions. The upcoming Corporate Connect will be featuring Cromwell European REITs next week on the 29th of August. Without further ado, have a nice evening. Thanks, everyone.
Thank you very much.
Thank you, everyone. Good evening.
Thank you.
Good evening.
Thanks.